Why does it feel like the market's against you and every time you open a trade it just loses? Well, there's probably a good reason for that, and it might not be what you think. I can tell you it's not just bad luck or that the market gods are against you, or maybe a little bit in your case. Just kidding. Whenever I see people saying things like the trade didn't go to plan or every trade I open is a loss, when I dig a bit deeper, it's usually the same situation. Most traders structure their trades with favourable asymmetric risk-reward ratios. It's what everyone's told to do, and in most cases, it makes the most sense for the situation because that's a big reason why you're deciding it's an opportunity in the first place. So what do I mean by asymmetric risk-reward? It's really simple. It means that one side of the potential outcomes is larger than the other. So for example, if we have a favourable asymmetric risk-reward ratio, it might mean that we're risking a loss of 1 to make a potential profit of 4. So in practical terms, if we look at this trade as an example, we have our stop loss set to 20 pips and the potential profit is 80 pips, which means it's a 1 to 4 risk reward. Now, just to be clear, most of my trades are asymmetric, so I'm not saying that that is inherently a problem. The real issue here is perception. Let me explain. Let's say that you're taking that trade from the example before, but the problem is you have absolutely no edge in the market, which, let's be honest, is the case for most traders out there, usually following some illogical trading approach. So with no edge, the probability of it being a loss is 80%. In other words, if you traded like that 100 times over, 80 of the times you'd expect it to be a loss and just 20 times a profit. Now instead, let's say that you do have an edge and that's why you're taking that trade. Smart move. Well, it would take a monumental trade of the century to shift the probabilities enough that the most likely outcome is a profit rather than a loss. Instead, we can think of it this way. The concept of having an edge is not that it means a profit is more likely than a loss on an individual trade. It just means that the probabilities are favourable enough that you'll have a profit overall if you take that sort of trade time and time again. What I'm describing here is basically the expectancy of your trade, and the combination of all of this is what leads to your trader's equation. If your trader's equation is positive, then great, you're a profitable trader. And if it's negative, you've got some work to do. But what it's not showing you is that you have more profitable trades than losing trades. Now, if this concept is something you're struggling with or you want to understand better, I've got something that will help. In the description box, you'll find a link to my free trading masterclass where I'll explain to you the logical formula for successful trading that focuses on probabilities and assessing the expectancy of our trades for the long term. It's full of insights and it will give you a whole new perspective on your trades, and it's one of the key principles of the Duomo method, which is how I trade. So go and check out that in the description box and grab a notepad. But let's bring this back to the key point here. So when you open these sorts of trades, you're expecting to have a loss. So when the trade does lose, and then you go and say something like, oh, the trade didn't go according to plan, well, that's not actually true, is it? Because you were expecting the result was going to be a loss, and then it was. But I have to admit, it feels a bit counterintuitive to open a trade expecting it to be a loss and still think that's a good idea. But you have to accept it and embrace it, otherwise you'll fall into this negative spiral and end up just being like all the other losers in the market. And here's what I mean when I say about a negative spiral. So a lot of traders will accept that they're trading asymmetric risk reward, and it's more likely that any individual trade will end up being a loss. And on paper, that's all fine. That is, until they actually start hitting the losses, and then all that goes out the window. They start hesitating, doubting their approach, and without realizing it, they start to self-sabotage. They'll start making changes to try and avoid losses. They'll tweak their system, over-adjust things, and end up with an inconsistent mess. Rather than improving things overall, they'll just end up securing themselves a negative trader's equation and a massive L that they can hold. If you've been watching our videos for a long time, you'll already know that I really like using sports analogies. So the one I've got lined up for this situation is like a striker who can't score. Now, if you're old like I am, you'll remember when Fernando Torres joined Chelsea, and practically overnight, it was like he was so bad at scoring that it seemed more like intentional satire. Some might say that's just the Chelsea effect. London is red. But what happens when strikers hit these dry spells, like Fernando Torres, is that they start getting into their own heads. Rather than seeing it as just a probability thing or just a temporary dip in form, they start overthinking and over-adjusting. And rather than continuing to do the right things that they were doing before, they constantly change things until they get themselves into an absolute mess and their confidence is absolutely shattered. So, bringing it back to trading, the key, if you're going through a Torres mindset, is to get yourself back to basics. Reconnect with the probabilities of your trades and understand how likely it is to go through a losing streak when you're trading with asymmetric risk rewards. I also see this all the time when traders analyze their data. So let's say you've been going through a bit of a slump, like you've not been getting the results that you thought you would. And so over the last 40 trades, you analyze what's been happening. And you've taken nothing but trades with a 1-to-4 risk reward ratio. And with your system, you're expecting to have a 25% success rate, which overall would mean that you're profitable. But when you analyze those 40 trades, you discover that your success rate's only been 20%. So what a lot of traders will do is they'll see that and they'll think, whoa, 20%, that is not good. And then they'll start worrying and going into this negative spiral. And actually, if you just stop panicking and look at reality, you'd realize that 20% of 40 trades is 8 trades and 25% of 40 trades is just 10 trades. So that's a difference of 2 trades. And with a small sample size of 40 trades, you can expect some variability, and 2 trades is really not that much. So being blunt and totally honest here, if you are losing overall with your trading, it's very likely to be because your trading approach is shit. Just saying, that's the case for most traders. But before you jump to that conclusion, you have to understand the probabilities of your trades and allow your trading approach the chance to perform. You have to allow the expectancy to play out over time before you can really judge where you're at. Having the right perspective is key for successful trading. And then once you've done that for a long enough period of time and you have a good enough sample size, you can start to analyze it to figure out if something does need to be changed or not. And if you want to understand more about what the right sample size is, check out this video next.